Welcome, everyone. Today, we're going to delve into a scenario many of us dream of, having £10,000 sitting in the bank. Now, while this might seem like a substantial amount, it's crucial to make smart financial choices to ensure that this money works for you. In this video, we'll explore some key actions you can take if you find yourself in this fortunate position. So, let's dive in and make the most of that £10,000. An emergency fund. Now, the first thing we need to address is the importance of having an emergency fund. An emergency fund acts as a financial safety net, providing you with a cushion to fall back on in case of unexpected expenses or emergencies. It offers peace of mind knowing that you're prepared for whatever life throws your way. When it comes to allocating funds from your £10,000, a common rule of thumb is to set aside 3 to 6 months' worth of living expenses in your emergency fund. Simply work out what your average monthly expenditure is for all bills and living expenses, and then multiply this by 3 or 6 months to get to the figure you need to set aside. By having an emergency fund, this ensures that you have enough to cover essential costs like rent or mortgage payments, utilities, groceries, and other necessities in case of job loss or unforeseen expenses. As for where to keep your emergency fund, it's essential to choose a place that offers easy accessibility while still earning some interest. Consider keeping it in a high-yield savings account or a money market account where your funds are easily accessible in case of emergencies, yet still earn a modest return on your investment. Avoid tying up your emergency fund in long-term investments or accounts with withdrawal penalties, as you may need quick access to the funds in times of need. Pay off high-interest debt. Now let's talk about something that can significantly impact your financial well-being: high-interest debt. It's crucial to address this promptly, as it can quickly spiral out of control and eat away at your finances over time. High-interest debt comes in various forms, such as credit card debt or payday loans. These types of debt often come with exorbitant interest rates, making it challenging to pay off the balance and leading to a cycle of debt if left unchecked. To tackle high-interest debt effectively, it's essential to prioritize and develop a repayment strategy. Start by listing out all your debts, including the outstanding balance and interest rates. Then, focus on paying off the debt with the highest interest rate first, while making the minimum payments required on the other debts. Consider using the snowball or avalanche method to accelerate your debt repayment. With the snowball method, you tackle the smallest debt first and then roll over the payments to the next smallest debt once it's paid off. The avalanche method, on the other hand, prioritizes debts with the highest interest rates, allowing you to save more on interest over time. Whichever method you choose, the key is to stay disciplined and consistent with your payments. Cut back on unnecessary expenses, increase your income if possible, and redirect any extra funds towards debt repayment. By taking proactive steps to pay off high-interest debt, you'll not only save money on interest but also pave the way for a more stable financial future. Invest in retirement accounts. Now let's shift our focus to securing your financial future through retirement accounts. Investing in retirement accounts is a crucial step towards building long-term financial security and ensuring a comfortable retirement. These accounts offer various benefits, including tax advantages and the potential for compound growth over time. By contributing to retirement accounts, you're not only saving for the future, but also taking advantage of tax incentives that can help your money grow more efficiently. There are several types of retirement accounts to consider, each with its own set of rules and benefits. Common options include pensions, individual savings accounts, and workplace retirement plans. Each type of account may offer different tax benefits, contribution limits, and investment options, so it's essential to understand the specifics of each. See our separate video on individual savings accounts and how to invest in the stock market for beginners. When it comes to allocating funds within retirement accounts, it's crucial to consider your individual risk tolerance and investment goals. Younger investors may opt for a more aggressive investment strategy, focusing on higher-risk assets like stocks that offer the potential for greater returns over time. On the other hand, older investors may prioritize capital preservation and income generation, favoring more conservative investments like bonds or stable value funds. Regardless of your age or risk tolerance, diversification is key to building a resilient retirement portfolio. Spread your investments across different asset classes and sectors to mitigate risk and maximize long-term returns. Consider seeking professional financial advice to help tailor your investment strategy to align with your retirement goals and risk profile. By making smart investment choices within retirement accounts, you can set yourself up for a financially secure retirement and enjoy peace of mind knowing that you've planned for the future. Build a diversified investment portfolio. Now let's talk about building a diversified investment portfolio to grow your wealth and mitigate risk over time. Diversification is a fundamental principle of investing that involves spreading your investments across different asset classes and sectors to reduce the impact of market volatility on your overall portfolio. The importance of diversification cannot be overstated. By investing in a variety of assets, you can minimize the impact of any single investment's poor performance on your overall portfolio. This helps to smooth out investment returns over time and can protect you from significant losses during market downturns. As an example, a loss in one asset class, such as a particular stock of, say, £1,000, could be offset by a gain in another stock or asset class of, say, £2,500. When it comes to building a diversified investment portfolio, there are several options to consider. Common investment vehicles include stocks, bonds, mutual funds, and exchange-traded funds, known as ETFs. Each of these asset classes offers unique benefits and risks, allowing you to tailor your portfolio to your individual financial goals and risk tolerance. Stocks, for example, offer the potential for high returns, but also come with greater volatility and risk. Bonds, on the other hand, provide income and stability, but typically offer lower returns over the long term. Mutual funds and ETFs offer diversification within a single investment vehicle, allowing you to access a broad range of assets with a single purchase. When constructing your investment portfolio, it's essential to consider your financial goals, time horizon, and risk tolerance. Younger investors with a long time horizon may be more comfortable taking on higher levels of risk and investing primarily in stocks for long-term growth. As you approach retirement or your financial goals, you may gradually shift towards more conservative investments like bonds to preserve capital. Regardless of your investment strategy, the key is to maintain a well-diversified portfolio that aligns with your financial objectives and risk tolerance. Regularly review and rebalance your portfolio to ensure it remains aligned with your goals and risk profile. Consider consulting with a financial advisor to help design and manage a diversified investment portfolio tailored to your individual needs. With a well-diversified portfolio, you can navigate market fluctuations with confidence and work towards achieving your long-term financial goals. Consider short-term goals. Now let's shift our focus to short-term financial goals. While it's essential to plan for the long term, it's equally important to address your short-term financial needs and aspirations. Short-term goals provide you with a roadmap for achieving your dreams and can serve as stepping stones towards long-term financial success. When considering your short-term goals, think about what you want to accomplish within the next few years. This could include saving for a down payment on a house, funding a dream vacation, or starting a small business. By identifying your short-term goals, you can create a plan to allocate funds accordingly and make tangible progress towards achieving them. To allocate funds towards your short-term goals effectively, it's essential to prioritize and budget accordingly. Start by determining how much money you need to achieve each goal and establish a timeline for reaching them. Then, consider how you can adjust your spending and savings habits to allocate funds towards these goals while still addressing your long-term financial needs. One effective strategy is to set up separate savings accounts or investment accounts for each short-term goal. This allows you to track your progress towards each goal individually and ensures that you don't dip into funds earmarked for other purposes. Automating contributions to these accounts can also help you stay on track and build momentum towards achieving your goals. As you allocate funds towards your short-term goals, be sure to strike a balance between short-term gratification and long-term financial planning. While it's essential to enjoy life and pursue your passions, it's equally important to maintain a focus on building a secure financial future. By finding the right balance between short-term and long-term goals, you can achieve financial stability and fulfillment both now and in the years to come. In conclusion, if you have £10,000 in the bank, take proactive steps to enhance your financial well-being. Build an emergency fund, pay off high-interest debt, invest in retirement accounts, diversify your investment portfolio, and consider short-term goals. By following these actions, you can make the most of your £10,000 and work towards achieving your financial goals. Subscribe for more financial tips and advice to empower your financial journey.